Treasury shares refers to entities' own shares that have been issued, reacquired, but not concealed. In order for a share to be classified as treasury share, the following three requisites must be complied. First, the shares must be the entity's own shares. Second, the shares must have been issued originally. And last, the shares are reacquired but not concealed. Our law sets legal limitation that no corporation shall redeem, repurchase, or reacquire its own shares of whatever class unless it has adequate amount of unrestricted retained earnings to support the cost of said shares. Therefore, the corporation can only acquire treasury shares only to the extent of retained earnings balance. In the case that the corporation were allowed to acquire treasury shares when it has no retained earnings balance, it would mean that the corporation is indirectly returning the capital to shareholders, which in fact a violation of the trust fund doctrine. In accounting for treasury shares, we used the cost method. Another method used in accounting for treasury share is par value or stated value method or retirement method. For the sake of discussion, we use the cost method in accounting for treasury shares. The par value or stated value method is not an acceptable approach because the legal requirement that retained earnings must be appropriated to the extent of the cost of the treasury shares. Transactions involved in the accounting for treasury shares are acquisition, reissuance, retirement. The journal entry to record the acquisition of treasury share, which is at cost. We debit treasury shares, credit cash. For reissuance transaction, we debit cash, credit treasury shares. If the transaction of reissuance is more than cost, we debit cash, credit share premium treasury shares, credit treasury shares. Remember that no gain or loss shall be recognized on the treasury shares of the same class. And when the balance of the share premium from treasury shares are not enough, it is charged to retained earnings. Again, the transactions involved in accounting for treasury shares are acquisition, reissuance, and retirement. The journal entry to record the acquisition of treasury shares, we debit treasury shares, credit cash. For reissuance of treasury shares, we debit cash, we credit treasury shares. In the event that the retirement of the treasury shares results in a loss, meaning the cost of the treasury shares exceeds the par value, we use the SPRE rule. Please take note that the share premium from original issuance is concealed on a pro rata basis in the absence of specific amount identified with the treasury shares. For the illustration, we have here ordinary share capital, 10,000 shares at 10 pesos par value, and treasury shares, 1,000 shares at cost. Question: what is the entry if treasury share is retired? We debit ordinary share capital. To compute, we get 1,000 treasury shares multiplied by the par value of the ordinary share capital, which is 10 pesos. So, 1,000 treasury shares times 10 par value is equal to 10,000. Then, we credit treasury shares in the whole amount of 25,000. Again, note that the share premium from original issuance is concealed on a pro rata basis in the absence of specific amount identified with treasury shares, so we debit share premium issuance. So for the computation, we get the 1,000 treasury shares divided by the number of the issued and outstanding ordinary shares, and we get 10% and multiply to the amount of the share premium original issuance. We debit in the full amount of share premium treasury shares 5,000 pesos. after the cancellation of the share premium original issuance on a pro rata basis. We also debit retained earnings account in the amount of 2,000 to cover up the resulting loss in the retirement of the treasury shares. For the presentation of the treasury shares, we can observe that the cost of treasury shares is deducted from the total shareholders' equity. For the disclosure, we disclosed the number of shares held in treasury and the restriction on the availability of retained earnings for distribution of dividends equal to the cost of the treasury shares. Recapitalization happens when there is a change in the capital structure of an entity. Thus, old shares are canceled and new shares are issued. These are the typical event of recapitalizations. We have change from par to no par, change from no par to par, reduction of par value, reduction of stated value, split up, split down. Change from par to no par. In the illustration, we have 10,000 shares at 50 par value, share premium amounting to 150,000, and retained earnings in the amount of 300,000. Again, recapitalization involves cancellation of old shares and issuance of new shares. In the illustration, we will cancel the 50 pesos par value of the ordinary shares, and we will issue new 10,000 shares at 25 stated value. For journal entry to record, we debit ordinary share capital 500,000 and we debit share premium 150,000. The reason why we include share premium is that share premium is related to the ordinary share capital. The entry to record the issuance of new shares, we have to credit ordinary share capital. To compute, we get 10,000 shares at 25 stated value. Also, we credit share premium recapitalization in the amount of 400,000 because any changes in the par value of share capital shall be charged or credited to the share premium account. Another illustration, we cancel the 50 par value shares of 10,000 shares into a 10,000 shares with 100 stated value. Again, we cancel the ordinary share capital and share premium by debiting both accounts. We credit ordinary share capital 10,000 shares at 100 stated value amounting to 1 million. Note that if the stated value of the new shares is more than the original issue price of the par value share, the difference is charged to retained earnings. In this case, we debit retained earnings 350,000. Change from no par to par. In this illustration, we cancel the no par 80 pesos stated value and issue new shares at 50 par value. The entry to record, we debit ordinary share capital in the whole amount of 800,000. We credit ordinary share capital for the new issuance. For the computation, we get 10,000 shares at 50 pesos par value amounting to 500,000. For the excess, we credit share premium recapitalization in the amount of 300,000. Another illustration, we cancel the no par 80 pesos stated value and issue new shares with 100 pesos par value. The journal entry to record, we debit ordinary share capital in the whole amount, 800,000. We credit ordinary share capital for the new issuance. For the computation, we get 10,000 shares at 100 par value amounting to 1 million pesos. And we debit retained earnings 200,000. Share split may be in the form of split up or split down. Split up is a transaction whereby the original shares are called in for cancellation and replaced for a larger number of shares, thereby reducing the par value or stated value of the shares. While split down is the reverse of split up. It is a transaction whereby the original shares are canceled and replaced by a smaller number accompanied by an increase in the par value or stated value. For the illustration, we have here 1,000 shares issued and outstanding with 100 par value, a total share capital of 100,000. We take for example the split up 5 to 1. So the amount of the share capital is the same, which is 100,000. We have now 5,000 shares. To compute, we get 1,000 shares times 5. And as you can observe that the par value of the shares is 20 pesos, not 100 par value. For split down, 5 to 1. Amount of share capital is the same, 100,000. The number of shares happens to be lower, which is 200 shares. To compute, 1,000 shares divided by 5. And the par value of the shares increased to 500 pesos. Please bear in mind that split up is multiply, split down, divide.